You walk into a bank. You hand them your paycheck history, your credit score, a stack of forms. They nod, they type, they approve. And just like that, $100,000 appears. No truck arrives, no vault opens, no one runs to the back room to grab your money. It simply exists. Here's the uncomfortable part. The bank didn't give you money it already had. It created it. And that isn't a loophole, that's the system. Right now, as you're watching this, banks around the world are creating new money out of thin air, quietly, legally, repeatedly. Not central banks, not governments, regular banks. And almost no one understands how this actually works. Which matters, because this mechanism quietly shapes housing prices, inflation, financial crises, and who gets rich first when new money enters the system. So let's slow this down, strip away the jargon, and follow the money step by step. Because once you see it, you can't unsee it. For most people, money feels physical, something that exists somewhere, a pile, a balance, a fixed amount. That instinct is wrong. Modern money is not a thing, it's a record. Numbers on screens, promises between institutions, entries in databases that must balance. And banks are the institutions trusted to edit those records. When you deposit money into a bank, you don't store it there like a coat in a locker. Legally, the bank now owns that money. What you have is a claim, a promise that they'll give it back when asked. That distinction is subtle and critical because it means your deposit becomes the bank's raw material. Let's say you deposit $1,000. The bank does not lock it away waiting for you to return. It records two things. On one side of its balance sheet, a liability. It owes you $1,000. On the other, an asset. It now has $1,000 to work with. And here's where the magic begins. The bank is allowed to lend most of that money out. Not all of it, just most of it. Why? Because statistically, not everyone withdraws their money at the same time. Banks are built on probability, on averages, on the assumption that withdrawals are staggered and predictable. So the bank keeps a small fraction in reserve and lends the rest. Now let's follow what happens when the bank makes a loan. You apply for a mortgage. The bank approves it. Do they transfer existing money from someone else's account into yours? No. They create a new deposit in your name. That's it. With a few keystrokes, the bank increases your account balance. New money is born. At the same moment, two things appear on the bank's balance sheet. An asset, your loan. A liability, your deposit. They cancel each other out on paper. But in the real economy, spendable money has increased. This is the part most people miss. Loans don't transfer money. Loans create money. Nearly all the money you use every day entered the system this way. Not from printing presses, not from government spending, from bank loans, mortgages, business loans, car loans, credit lines. This is why housing booms explode so fast. Banks don't need to have the money first. They just need confidence that borrowers can repay. When confidence is high, money creation accelerates. When confidence collapses, it stops. And suddenly, the system freezes. We'll get to that. But first, let's confront the question that should be bothering you. If banks can create money like this, who limits them? The answer is unsettling. Not vault cash, not deposits, capital and confidence. Banks are constrained by capital requirements, rules that say they must hold a certain buffer of their own equity relative to their loans. In theory, this prevents reckless expansion. In practice, the limits are flexible, complex, and often bent during booms. Because during good times, assets look safe. Housing prices rise, businesses grow, defaults look unlikely. So banks lend more, which creates more money, which pushes asset prices higher, which makes banks feel safer. It's a feedback loop, and it feels amazing while it lasts. This is where the story turns, because the system works beautifully until it doesn't. When borrowers struggle, loans stop looking safe, banks tighten lending, money creation slows, but existing debts don't disappear. The economy is left with yesterday's debt and today's fear. This is why crises feel sudden. The system isn't slowly running out of money, it's slamming the brakes on money creation. And when most money is created through debt, slowing debt creation feels like money vanishing, because in a sense, it is. Here's the irony. Banks don't lend money they don't have. They create deposits by lending. Deposits don't fund loans. Loans create deposits. This flips the story most people were taught. It also explains something strange: why banks desperately want you to borrow during booms and desperately don't during recessions. They aren't just intermediaries, they are money manufacturers whose product only exists when someone signs a loan contract. Now zoom out. If banks create most money, who controls them? This is where central banks enter the story. Central banks don't directly create most of the money you use. They influence how willing banks are to create it. They set interest rates. They provide reserves. They signal support or restraint. Think of central banks as traffic controllers. They don't drive the cars. They adjust the conditions. Lower rates make borrowing cheaper. Cheaper borrowing encourages more loans. More loans create more money. Higher rates do the opposite. This is why interest rate changes ripple through the economy with such force. They don't just affect prices, they affect money creation itself. And now we reach the uncomfortable math. Every dollar created by a bank loan comes with interest attached, which means the system always owes more money than exists. The interest isn't created up front. It must be earned, borrowed, or refinanced later. This keeps the system dependent on continuous credit expansion. Growth isn't optional, it's structural. When growth slows too much, debts become harder to service, defaults rise, banks pull back, and the cycle reverses violently. This is why crises are not accidents. They are built into the design. During calm periods, the system looks stable. During stress, its hidden mechanisms become visible. Banks stop lending, money creation stalls, liquidity evaporates, and suddenly everyone realizes how dependent the economy is on institutions that create money by believing in the future. There's a quiet absurdity here. Banks create money by assuming tomorrow looks like yesterday. When that assumption breaks, so does the system. This is why governments rush in during crises, not to save banks out of kindness, but because if banks stop lending, the money supply shrinks. And when money shrinks in a debt-based system, everything cracks. Jobs, businesses, tax revenues. So governments backstop banks, guarantee deposits, inject capital, because the alternative is systemic collapse. At this point, the question shifts. If banks can create money, who benefits first? The answer is uncomfortable. The first recipients of new money always benefit the most. Borrowers with access to credit, large institutions, asset buyers. By the time money reaches wages and everyday prices, its purchasing power is already diluted. This isn't a conspiracy, it's mechanics. Money enters the system unevenly,
and those closest to credit creation feel it first. This is why asset prices inflate faster than salaries, why housing becomes unaffordable, why inequality quietly widens during credit booms. The system doesn't distribute money evenly, it distributes it through balance sheets. Now step back even further. Banks don't need to conspire, they just follow incentives, create loans, earn interest, expand balance sheets. As long as regulators allow it and borrowers comply, money keeps flowing. The system doesn't ask whether this is healthy, only whether it is legal, profitable, and temporarily stable. And stability is always temporary. Which brings us to the quiet truth at the center of modern finance. Banks don't lend money they don't have.
They lend money that didn't exist until they decided to create it. This power built the modern world. It funded growth, innovation, housing, infrastructure. It also built fragility, cycles, and recurring crises. Both are true. So the next time you hear that banks ran out of money, remember this. They didn't run out of money, they ran out of confidence. And when confidence disappears in a system built on promises, numbers on screens stop behaving like money. They become something else, obligations without trust. And that raises a final question. If most money exists only because banks believe loans will be repaid, what happens in a world where belief itself becomes fragile? Because that's not a technical question, it's a systemic one, and it doesn't have a clean ending.